Joining me now is Robert Kaplan, Goldman Sachs Vice Chairman and a former Dallas Fed President. Robert, great to have you on.
Good to see you,
you
Mike.
call this this decision an agonizing one for Fed voters in this coming meeting. I guess given the fact that labor market has definitely softened up and we still have inflation sticky above the target. What do you think is going to kind of break the majority in one direction or another?
Yeah, I think this is one time where the market probabilities at 50-50 have it about right. And if I were in my former seat, I would use every bit of the time between now and December 9th to assess this and make a judgment. But the agonizing part is exactly what you just said. Tariffs in the near term are slowing growth. The immigration policies, uncertainty around 12 to 15 million immigrants that are in the workforce is not only affecting supply, but I think it's also hurt growth and created some headwind on demand. And then lastly, the shutdown. Obviously, the shutdown is getting resolved, so that will help. But it's not surprising that the labor force is weak. What the Fed's going to try to have to figure out is, as we go into 2026, will the tailwinds be more powerful, have more force? The shutdown will be unwound. You've got tax incentives coming. You've got regulatory relief coming. You're still in the middle of an AI data center power boom. And the problem is they're near neutral on the Fed funds rate. And that's why the stakes are much higher on this decision, because they're so close to neutral.
Well, that's interesting because obviously pretty much everybody has his or her own version of where neutral sits, right? I mean, we're at 3 3/4 to 4%. That's the current Fed funds rate range. You obviously have Stephen Myron, who has dissented in favor of a 50 basis point cut. I think that, there's a sense out there that he believes neutral is much lower or should be. So where do you think it rests, and what does that mean for how this debate is going to develop?
So I think the real Fed funds rate, neutral Fed funds rate, i.e. ex-inflation, is probably between 3/4 and 1%. And I've found it hard to find many people who have estimates below that. So then the debate is, for those who think the neutral Fed funds rate today, nominal should be 2 3/4, I think they're assuming that inflation is going to return to 2%. The problem is it's running at 2 3/4 to 3, and it's been above target for 3 or 4 years. So I take the 3/4 to 1%, add the current inflation rate of 2 3/4 to 3, and I get 3.5, 3 3/4. Now, why might I be wrong? If inflation improves into next year, that would lower the neutral rate. But I think you're more likely to see into the first half of next year a firming in inflation. Maybe over the horizon you'll see improvement, but I think that's a leap of faith to think that the inflation rate is going to improve in the first couple of quarters of next year.
So I might have thought at the beginning of the government shutdown, even if it persisted, as long as it turns out it did, that we were going to be deprived of most real-time economic data from the government, and that might have tilted the committee more in the direction of, okay, I'm going to err on the side of easier, not tighter. That doesn't seem to have been the case. So I wonder if there's particular things you think that these hawkish voices are focused on that's come in recently, or it's just a matter of we can afford to wait.
I think here's the reason you're hearing more hawkish voices come out. We're closer to neutral. We cut in October. We're another 25 basis points. That's why you're seeing the split. In fairness, secondly, the shutdown has hurt growth. So that's a factor arguing for cutting. But I think the fact that inflation's been sticky and we're getting close to neutral, I think, do you really want to be at neutral when inflation's running 3/4 to 1% above target? And that's why I say it's a game time decision, and I'd take all the time between now and December, because I really want to every day and every week assess what's really going on in the labor market. How much of this is a real cyclical slowing? How much of it is due to the shutdown, which is getting reversed? And how much of this is structural, i.e. mismatches between people looking for jobs and open jobs, which there's a lot of open jobs that can't get filled. And I think they're trying to come to grips with that.